All right, so we mentioned some softness for stocks and what's been a softer month as investors digest all sorts of earnings stories, get ready for a Fed decision this week. And even ahead of that, we got a reminder that perhaps markets got ahead of themselves on the interest rate cut narrative that was so strong earlier this year in the United States. At the same time, we've got signs that Canada's economy is cooling down. So let's get some perspective on what that means for Canadian investors. Garnet Anderson is Vice President and Head of Portfolio Management at Tacita Capital, and he joins us here in studio. Busy month.
Busy month.
Never a dull day. I guess of all the stories that you're tracking right now, how does it make you feel about the investing landscape?
Well, we're still constructive on the equity market, despite the run-up in states, particularly on the valuation side. I mean, you have some underpinnings in terms of earnings growth coming through the pipeline. But when you take a look at the run, A, that we've been on, B, where valuation levels are, there's not much room for error. So when companies come out and they disappoint, I think we're seeing getting hammered more now vis-a-vis 4, 5, 6 months ago where they got passes. So again, constructive on equities, coming over to the fixed income world, and we talk about, the economy coming in a little bit softer. We've been well underweight bonds for years and years and years. We just weren't getting paid for the risk on the table. As rates have moved up, we still bear the interest rate or duration risk. But at least now we're getting paid for that risk for all intents and purposes. Still want to stay in quality. But the other thing, too, is remain at the short end of the curve. Because if inflation remains sticky, we're seeing oil, it's hard to get that last mile inflation down. We think that we can grab the extra yield without taking on the duration risk. So that's really the overall broad portfolio down.
The stock market is competing for some attention.
Well, certainly it is. Really, there's what areas are really beaten up left in the world? Okay, so you can point to China, maybe a couple of the emerging markets. You would still take a look at renewables and utilities and real estate. They are still beaten up. They're waiting for some. We saw it in early October when interest rates looked like they were coming down in the cuts and they felt the whole yield curve was going to come down. You could see the party was ready to go. Well, that got put on pause. So if the economy softens, depends how it softens and how interest rates come down, that could be an area of opportunity for investors.
Okay. Well, we do have a Fed decision this week as well. So here's where we are as of this Tuesday morning. We got a reminder of a Canadian economy that's resilient / cooling, and maybe there's an interest rate cut coming. We've got continued signs that the Fed has some wiggle room before they cut.
Yeah.
What kind of messaging are you watching for from Jay Powell and the Fed this week, and how does the market respond to that?
Well, they've got that labor tightness that we don't have. And I think while every economics 101 textbook tells you that, that jobs aren't a great predictor of where the economy is going, jobs are pretty darn important. And so I think that's important. When we take contrast where we're at the beginning of the year, 6 cuts now down to 1 to 2 cuts later in the year, that seems still be on the table. You are starting to hear more chitter-chatter about, well, maybe they'll increase interest rates. I think it would take a pretty big shock on the inflation side for them to go down that road. On the flip side, what we've been saying for months now is no central banker wants to make the same mistake that was made back in the 70s. Now, there were external factors, OPEC, oil crisis, but inflation ramped up, inflation came back down, coast is clear, they started to drop rates, and then inflation just ramped back up. Different dynamics again, but OPEC at the center of it, and conflict at the center of it. And then next thing you know, you had Volcker coming in and just slammed rates higher.
We don't know where the inflation carousel ends, but to your point, it will be something we cannot ignore. You started the conversation by talking about the reactions to earnings as well, which is a consideration. We just mentioned in our newscast that Cameco shares are under some pressure. Kind of interesting, just because this is a company that is building its business out to sort of capitalize on growing demand for uranium, but being able to be at multiple points of the servicing of that demand. Now, I guess the stocks had a pretty good run, and I wonder if that factors into the reaction. But this is a name that you said constructive earlier about the markets. Are you constructive on Cameco as an investment?
Yes, within our TCIP VQM Canadian equity pool, that is one of our holdings. And really, it's why do we hold it? Well, first of all, it's a moat-like company. There aren't too many uranium mines being built around the world. Their other services are pretty specialized in nature. They did go for the vertical integration, partnered up with Brookfield, and go and bought 49% of Westinghouse. So that's positive. When we took a look at the results, what we're almost neutral on is the big write-off that came in terms of what they wrote down their Westinghouse assets to in Q1. It's kind of, we've seen that story before. You go, you make an acquisition, you digest, you try to take as much of the bad news in the first quarter, get it out of the way. So that was not a surprise. In terms of some of their volume sold, that was off. That was a little bit disappointing. On the positive side, they took on $600 million of debt for the purchase. They paid down about $200 million of that. That's going to be a continued focus. I think that's critical. Two, they are entering into new contracts with higher pricing, because right now there's between spot and what their average rate is. Their cost structure is like every other business. They are facing higher cost of goods sales, and how they manage that and what aspects of that they can actually control are a little bit tough. It's not the first time that they disappointed. After last quarterly results, the market sold off. It sold off again today. So I think the signal out of that is, yes, you had a strong run up. Yes, it's pumped up valuation levels. Yes, you have to manage expectations in the marketplace. But when you get those disappointments, we're going to get these setbacks. Having said all that, it's a well-positioned stock for the next, number of years as they build out, as countries are looking for energy independence and move away from carbon. But if you keep on disappointing the market, that momentum will work against you and you have to exit.
Okay, I want to talk about a big U.S. story in McDonald's. They're out with quarterly results. We keep talking about a resilient American consumer, but some of the takeaways with the quarter were maybe consumers are a little bit more cautious. I don't know how cautious they get at McDonald's compared to making some other big decisions with their money. But the other thing with McDonald's as a global brand at a time of geopolitical tensions worldwide, they seem to have been a target, some of their locations in some markets as well.
Yeah, and they're not alone in that. And there's some anxiety amongst the others that will be kind of a rotating focus of protests. Their international revenues and profits actually didn't disappoint, because you had some growth in Europe, ex-France, that kind of helped carry through their international markets. They had strong growth out of the U.S., both in terms of revenues and profits. They're buying back shares at quite a good clip, so their earnings per share have gone up. Again, it's a good brand. Their ROEs, their ROAs, and their margins are something to dream for in most quarters. They've been on a run. So we don't see change in our thesis. Most prognosticators are saying, okay, or analysts are saying, once they get to the end of the conflict in the Middle East, then things will retreat and those stores will get back up. Having said, it's a global empire, if you want, in the fast food world. Perhaps almost the other thing for them to be taken, or for us all to take a look at, is what are the competitors going to do on promotion front? And will that drive McDonald's to reduce their revenues and the cost of their products through promotions, all the while having the same cost structure? That's probably the more systemic thing, permanent thing to keep an eye on.
Okay, a trend we'll watch, as we're also watching some of the other restaurant operators like the parent of Tim Hortons. And then finally, we've had a lot of discussion today around the real estate environment in this country. And for investors, the story of a tight supply-demand picture for housing in this country is actually something that they can play through a number of real estate investment trusts. How do you approach that?
Well, we think it's core. I mean, it's a large part of the REIT market. There's a handful of good, solid REITs in there. Like, for example, we were to take a look at Boardwalk REIT. About 75% of their units are out in Alberta and Saskatchewan. Net immigration, particularly to Alberta, is 10,000 per quarter for the last 5 quarters. Then you've got the foreign immigration coming into Alberta, because why? Lower cost of living, and it's an attractive environment. So that has helped boost their occupancy rate up to about the 99%. Double-edged sword there is them and others in other provinces. You need some of that unit turnover so that they can move rental rates up to market levels. The flip side is you don't just take the keys from one tenant and pass them on to the next tenant. You have to go and refurbish the unit every time. And those costs of refurbishments are increasing. What was interesting with MBI.UN was they went in and they raised capital at, was it 68.50 or what have you, not that long ago, to go and expand and go out and buy some new properties. They thought they could get some creative deals. And now the prices continue to move up. So all engines are firing. probably not massive upside in terms of value. It could be 10, 12, 15%, but very well-run REITs.